New highs all around. S&P 500, junk debt, equal weight S&P 500, Europe and Canada all hit record highs today. The dollar still looks vulnerable. Midweek it looked better, but there is a catch and gold might be topping out. We'll try to examine if it is indeed. And we'll finish up with bonds, which could be stabilizing. All this and more in today's edition of MasterChartsTrading.com market recap for Friday, August 14, 2026. Always don't forget to hit the like button, share this video, make a comment, put even a thumbs up in the comment section. It keeps this channel going and makes this channel available to more people. Thank you for all the comments I've been getting and the likes. If you're a subscriber, stay tuned. We'll cover various securities, including market breadth, some of the ETFs, as well as some of the large cap stocks and some of the speculative securities in the members only section. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators, which are available at my website at MasterChartsTrading.com. Okay, let's look at S&P 500 first. We're seeing fresh records yesterday on the 13th of August, Thursday. Today we kind of tried to get up, but so far failed. In the members only section, I will look at the put to call ratio, which is now getting a little bit overextended in this exuberance phase. So people are thinking again that we're going to go to the moon. Usually that's a recipe for at least a mild pullback. So far the pullbacks, you can see we've been having very mild pullbacks towards the green support resistance line. Again, you can find out more about these lines. So far these pullbacks have been pretty much very shallow. You can kind of see we're riding this green support resistance line higher and higher. So a pullback of similar magnitude would be, like a normal garden variety affair. Something deeper, of course, would look something like, let me get to small caps and I'll show you what a deeper pullback looks like. High yield bonds also hit a record yesterday, so no discrepancy between high yield bonds and S&P 500, and let me show you why that is important. So here are the junk bonds, JNK, ticker symbol JNK, and you can see that the down below here is the correlation coefficient is extremely positive. Like a vast majority of the time, high yield bonds and stocks correlate to one another. In other words, they're doing the same thing. So when high yield bonds hit records and at the same time stocks hit records, that's a great thing. There's no divergence. RSP equal weight ETF equal weight S&P 500, where all of the stocks within it are weighted equally, and Google and Nvidia and Meta are all weighted accordingly. So they're like 0.6% I think of the index or something of that nature. So this is showing again that we're seeing very broad participation from the entire stock market, or at least entire S&P 500. Very strong, very broad participation. Notice this ETF hasn't even touched the green line since April of this year, whereas S&P at least pulled back slightly a few times. RSP equal weight ETF hasn't even done so. So this is just showing just how strongly smaller stocks are contributing to the general stock market, which is, I think, a very, very good indication, showing that the economy is doing pretty good, I think. No problems so far. And this is despite all the terrible news from Middle East and Ukraine and God knows from elsewhere. So overall, the United States economy is in very good shape according to the stock market. And stock market is the ultimate arbiter. However, we can also say the same thing about Europe. Europe just hit an all-time high. This is European 50 stocks. Same can be said about individual stocks of various countries. This United Kingdom, here's the German DAX, also at all-time highs. You know, so pretty much all of the Europe is doing, you know, just fine. A subscriber recently pointed out that the Canadian markets also hit a record, and although we Americans like to blame Canada for pretty much everything under the sun, we can't really blame them for this. So this looks like a good thing. And we're seeing record highs for Canadian market. Also look, the Canadian market is actually outperforming, because notice again how strongly it is even riding above the green support resistance line. Also hasn't touched the green line since March of this year. So overall, stocks are doing very well. Call it good economy, call it inflationary pressures, whatever you want to call it. I don't see a big problem, and like I said, because of the junk debt being also at record highs, I don't see a problem. I don't see a negative divergence of any sort. So overall, I would continue looking for buying opportunities. Let me again, I forgot to show you what a deeper pullback would look like. So for example, here are small caps. So like that's not a really good example, is it? QQQ, sorry, I meant QQQ, NASDAQ. So yes, here's NASDAQ with record highs back in June. And notice that actually NASDAQ has been lagging somewhat, and the rest of the market has been doing better. But you know, that has to do with the technologies being slightly underperforming last few, you know, few weeks maybe since June. But notice again, this is what a deeper pullback looks like. So we pull back all the way down to the blue line, and then again same thing, we just buy it on close above the blue line. So this is an actual alert, and I think new records for NASDAQ would be quite likely at this point. So I had some concerns a few weeks ago, specifically about XLC, communication services, which actually indeed was under severe pressure, most likely due to the construction of this ETF, with Meta, Facebook being 25%, a quarter of this ETF is Facebook. And so yes, it pulled this into a quote-unquote bear market, and in fact it reaffirmed it on July 24th. But notice again, we're very close to the blue line again, so a close above it, and we're back in the bull market. So I think stocks are doing just fine. I think some of these bearish indicators are artifacts of construction of the ETFs, and I think the bigger and the much better indicator is this equal weight S&P 500 being at records. This is as firing on all cylinders as it gets. All right, let's continue to the Forex universe and gold universe. Here's US dollar. So last week I pointed out this candlestick right there on the 7th of August. I'm going to zoom in a little bit. Okay, right there, this is 7th of August, and it looked very, what I called vulnerable. But then over the next 3-4 days, we actually moved higher, made a high on yesterday and Thursday. But today, actually, there was quite a bit of selling. So notice again, 3 times. This is the 3rd time that we're retesting this blue support resistance line. Today was another day. Throughout the week, I was thinking that maybe dollar is done correcting. But again, these type of candlesticks, ones I'm circling right now, large red candlesticks. They don't just appear out of nowhere. And I think I already showed you this. USD JPY was the first canary. This is a big red candlestick, and they don't just come out of nowhere, and they don't just disappear. So the same goes for this dollar currency index, DXY. This type of candlesticks could get retested. I mean, we might get, a small rally again, something like maybe towards here. But I think that now there is resistance below there. So unless we suddenly just collapse, through this blue support resistance line, we might get a small retest. But another way of looking at this is to think in terms of how big is this candle, is this drop. So like from the recent high, this beginning of this downturn to the blue support resistance line, that's a 2% run. So if this gets duplicated on the downside, that means we're going to be below the red line relatively soon, and this would imply a bear market for the dollar. Just like we had. This is the bear market for the dollar that started back in March of 2025 and continued until we finally broke out above the blue line in March of 2026, and the bull market started. So this bull market could be very short-lived. It's possible. This is a very vulnerable state of the dollar. 3 times we're retesting this area. These red candlesticks don't look too good. So we will see again next week. Next week I think will be crucial, because if this support doesn't hold and we continue lower, it could be just like a collapse in the dollar because of this very, very large red candlesticks above. So this is purely candlestick analysis, basically. Let me know in the comments what do you think about the dollar. Why do you think this is happening? Maybe this is something fundamental as well. I mean, I'm sure it's fundamental. It's not just it's not just technical. Looking at gold is indeed taking advantage of weakening dollar. So notice this breakout here on August 5th. If we look at the dollar actually started falling a little bit earlier. August 5th is right there. So interestingly enough, the move for the dollar started before gold even reacted. Gold didn't even react until August 5th. But it did react finally. And now I'm wondering, is gold topping here, or is it just getting started? If we project the indicators into the future, we can see that they're sort of turning up a little bit. So I've seen this many times before, where the security kind of comes down and rides this projected indicator into the future, just rides it sort of the way it's drawn. So we could see like slight drift for gold higher. Technically speaking, right this instant, gold is still in a downtrend. So, if somebody put a gun to my head and said, do you want to buy or sell gold? I want to sell gold right now. But nobody, thankfully, is putting a gun to my head. So I would probably just do nothing at this point with gold. If or when we see a breakout above the blue line, so currently at 4,767, then maybe we will start buying it. But right this instant, we are overbought, but in a downtrend. So we're overbought in a downtrend, but there is no new signal. The old signals so far have not worked out, all 3 of them. Notice this signal back on June 10th, another one on June 23rd, and yet another one on July 7th. None of them worked out. So 3 signals not working out, and there is another belief about the stock market that things work in threes, so like 1, 2, 3, and then the fourth time something opposite happens. So maybe this is what's happening. We have 1, 2, 3 signals, and then the fourth one actually went the opposite direction. So entirely possible. We need to wait and see. Gold miners, GDX, actually much stronger. Again, we also had a couple of signals. Actually, we had another signal, 3 signals, or even more signals, 4. We have a bunch of signals here. There's another signal right there. So many signals, as many as 5, 6. Let me see, 6 signals, and so far all of them did not really go anywhere. And then boom, big rally. Starting on August 5th. Very close to an outright bull market for gold. So this is also important, gold miners rather. So again, also important to kind of take that into consideration. Perhaps gold miners are leading gold higher. Entirely possible. Entirely possible. If or when we close above this blue support resistance line for GDX, for gold miners, that's 94.30. I'm reading it right off the chart. And again, you can get those indicators on my site. So yes, absolutely. In that case, gold miners could be considered a buy signal. That would be considered a buy signal. Unfortunately, there's gigantic gaps here below. So there's one gap between August 6th and August 7th, and another one between August 4th and August 5th. And then another smallish one here between August 3rd and August 4th. So yes, indeed, lots of gaps, but a gap indicates buying pressure. A gap up indicates a buying pressure. So people really wanted to own gold miners out of the blue suddenly. So all of that combined together is making me think that I don't know what's going on. Okay, I need to wait and see. Right this instant, gold, or rather dollar, is still technically speaking in an uptrend, but it looks vulnerable. And as I explained above, we could easily just collapse because of this large red candlesticks above here. And this is actually Bank of Japan and Treasury intervention that became known a little bit later, not at the time of the actual intervention. So yes, gold is reacting positively, and gold miners are reacting extremely positively to the news. Again, we'll need to watch what happens. The indicators are also kind of curving up, and they could be, we could see multiple scenarios here. So next week could be quite crucial for gold, honestly. Finally, let's finish up with Treasury bonds and the Treasury bond yield. So this is a 30-year Treasury bond yield, ticker symbol TYX. It is close to I believe it's a 30-some year high, if I'm not mistaken. Let me double check. Oh, sorry, 19-year high. So we just recently hit a 19-year high for TYX. Turn off the indicators for a second. I already showed this chart in the past, so if what I'm seeing is correct, and this is indeed some sort of a cup and handle pattern, and we just broke above the cup lid or the handle, then we could see a dramatic increase for interest rates to the tune of 22%. This is a 30-year yield, don't forget. Current yield is at 5.2. Projected yield could be as high as 6.5 in about a year or so. Can this happen? Absolutely. Why? Well, because the United States is borrowing like crazy, and I think the debt is just growing out of control. So eventually, possibly now, the bondholders or the people, or rather the banks and the various institutions in the various countries around the world who buy United States securities, Treasury bonds, will say, well, we want higher yields, we want higher returns. So that could be the reason. However, there is a possibility that this is getting stabilized, at least in the very short term. So here is why. Here's TLT Treasury, 20 plus year Treasury bond fund. So think about bonds as opposite of yield. I just showed you the yield. Yield is basically at 19-year high. The bonds are actually, well, if we remove the dividends, they're going to be probably actually easy to check. Let's look. I'm going to remove the dividends, and yes, indeed, we just broke below 2023 lows. Yeah, so this is bad. Yeah, with dividends or other coupons, it looks much better. So I generally look at bonds with the coupon included. So this candle right here on the 31st of July looks like a hammer candlestick. Another candlestick that looks like a hammer today. So potentially it might be stabilizing. There could be some sort of stabilization. Maybe at least for the time being, the rates won't really pop ever higher. But overall, the fiscal issue is at hand, and this is fundamental data. I don't really analyze fundamentals, but I'm looking at the chart and I'm seeing that maybe somebody is trying to do something about the insane borrowing that we're doing. Okay, that's it for this week's recap. Head over to MasterChartsTrading.com. Sign up for my mailing list at the very least. But if also you are ready, go ahead and sign up for the trading indicators. So trading indicators are for TradingView.com. You need only a free TradingView account to get my indicators. So once you sign up for free TradingView account, come back to my site, MasterChartsTrading.com. Sign up for trading indicators. I will open the door for you on TradingView.com, so you will see the same lines on your chart. Pretty easy, right? Newsletters, again, you can sign up for newsletters as well. I send out daily alerts and weekly members only videos. So if you, this week we'll be covering all of these various securities. Best deal is to sign up for both trading indicators and newsletters. Best deal of the weekly, rather monthly versus yearly is to get the yearly, of course. So it's a $49.95 equivalent if you sign up for the year, or $59.95 per month if you sign up for monthly subscription. There's always a free 7-day trial, so you can try it out. Let me know if you have any questions. Again, please don't forget to hit the like button, put a thumbs up in the video, or make a comment. Thank you for watching. Have another great trading week. Bye-bye.